Every oil panic teaches the same brutal lesson, and the crowd still refuses to learn it. Gas jumps almost $1 in a week. The Dow drops hundreds of points. Television tells you the world is breaking. Traders stampede into oil, gold, and defense. They dump technology, consumer names, airlines, and anything that looks even slightly future. The move feels intelligent because it feels urgent. That is exactly why it is usually expensive. I have watched this movie too many times to confuse noise with insight. When oil spikes, most investors stop asking the only question that matters. They stop asking whether the shock is permanent enough to damage the earning power of good businesses over many years. Instead, they ask a much weaker question. They ask what is going up this week. That is how people end up buying the spike and selling the bargain. If you want the mother line before I go any further, here it is. In an oil crisis, the first trade is usually emotional. The profitable trade is usually delayed, disciplined, and aimed at the assets fear has temporarily mispriced. That is where fortunes change hands. I am not saying oil does not matter. It matters enormously. Oil is not a side character in the global economy. It moves trucks, planes, ships, fertilizer, plastics, freight rates, and confidence. When crude jumps, it behaves like a tax on daily life. It reaches into grocery aisles, delivery costs, airline tickets, and factory margins. It can absolutely hurt the economy. But there is a second truth, and it is the one that saves investors from doing foolish things. An oil spike and an oil regime are not the same thing. A spike is a shock. A regime is a long enough period of pain to change behavior, crush spending, squeeze profits, and finally create a recession. Most people trade as though every spike is automatically a regime. History says that assumption has been wrong again and again. I want to walk through this the way I would if my own family money depended on it, because in spirit it always does. First mechanism, I call it the spike trap. The spike trap begins the moment prices move so violently that people stop valuing businesses and start valuing headlines. Oil jumps, energy stocks surge. Commentators tell you this time is different. You look at what is green on the screen and your brain quietly translates momentum into safety. That is one of the oldest mental mistakes in markets. The truth is that a stock which has already run hard on fear is often the place where future returns have already been borrowed from you. You are paying tomorrow, S optimism to solve today, S anxiety. We have seen this before in 1973. We saw it again in 1979, we saw it in 1990, we saw it in 2008, we saw it in 2022. In each case, oil spiked hard. In each case, the obvious trade looked like the right trade. Buy energy, sell everything touched by growth. And in each case, the spike eventually reversed. In 1973, the OPEC embargo sent oil from roughly $3 to $12. In 1979, the Iranian Revolution helped push it from around 13 toward 40. In 1990, Saddam invaded Kuwait and oil doubled almost instantly. In 2008, speculation and panic carried oil to $147 before it collapsed around 80% within months. In 2022, Brent reached about 130 and then fell sharply within 4 months. The pattern is not subtle. The emotional trade wins first. The patient trade wins later. That does not mean you automatically short energy or ignore risk. It means you refuse to mistake an early winner for a long-term bargain. Second mechanism, I call it the duration test. If you ask me what separates a painful headline from a truly dangerous macro event, I would not start with the headline. I would start with the clock. Duration is everything. The current disruption looks frightening on the surface for good reason. Oil pushed toward $119 intraday. The Strait of Hormuz, a passage only about 21 miles wide, handles roughly 20% of the world. Oil supply, tankers can sit idle, traffic can stall, spare capacity can exist on paper, and still be useless in practice if the route itself is compromised. That is why lazy comfort is dangerous here. You cannot dismiss a supply shock just because earlier crises eventually normalize. Some disruptions are brief, some metastasize. America's strategic petroleum reserve stands around 415 million barrels, well below full capacity. On paper, OPEC talks about spare supply. On paper, Saudi Arabia and the UAE can produce more. But if the arteries that carry the barrels are constrained, theoretical spare capacity is not the same as practical relief. Investors who ignore that fact are just doing optimism theater. So I take the risk seriously if Hormuz reopens quickly. You likely get a sharp spike and a fast unwind. If the disruption drags for months, recession odds rise substantially. That is the whole duration test. I do not need to know the headline of tomorrow. I need to know whether the world is moving toward normalization or entrenchment. Third mechanism, I call it the oil tax. When oil rises, I do not think first about crude. I think about household bandwidth. A middle-class family does not experience an oil shock as a chart. They experience it as less room in the checking account, less room for groceries, school supplies, car repairs, travel, restaurant meals, and everything discretionary. Diesel matters here just as much as gasoline. Sometimes more diesel is what moves the economy. Physical body, trucks move food, ships move inventory, warehouses move replenishment. A near 90-cent jump in diesel in a single week is not a trivia point. It is a price signal traveling through supply chains. When that signal travels long enough, margins compress. Businesses start passing along surcharges. Consumers postpone purchases, confidence weakens, hiring plans get smaller. This is why I say oil behaves like a tax. It extracts spending power without sending you an invoice. Now, here is where you have to resist the temptation to reason like it is still 1979. Back then, oil represented about 1.5% of America's GDP. Today, it is closer to 0.4%. That is not a rounding error. That is a structural change. The economy is materially less oil-intensive than it was decades ago. Cars are more efficient. Natural gas displaces heating oil in many contexts. Remote work reduces commuting miles. Renewables matter more than they used to. The economy can take a higher oil price today with less absolute damage than it could when oil sat deeper inside every economic organ. That does not make us immune. It just means the threshold for recession is higher than many fear. Driven comparisons imply, this is the mistake I see over and over. Investors borrow the emotional memory of old crises without adjusting for the changed structure of the economy. They use yesterday's vulnerability to price today's assets. That is how mispricing begins. Fourth mechanism, I call it the recession gate. Here is what matters more than the severity of the event itself. Does it cause a recession? That is the gate everything must pass through. Markets can absorb shocking headlines if the earning power of businesses survives. Markets struggle when a temporary shock becomes a prolonged collapse in spending, employment, and credit quality. That is why the same oil chart can produce wildly different investment outcomes, depending on whether it crosses the recession gate. History helps here. During major geopolitical shocks, the average drawdown in the S&P 500 has been around 4.7%. The average time to bottom has been about 19 days. The average recovery has taken roughly 42 days, about 70% of the time. The market is higher 12 months after the onset of the conflict. Those are not guarantees. They are reminders. Markets are discounting machines, not morality plays. They overshoot fear very quickly, then reprice just as quickly when survival becomes more likely than catastrophe. In 2022, that is exactly what happened. Oil surged to around $130. The Nasdaq was hit hard. At the lows, QQQ had fallen roughly 33%. Everybody wanted the perceived safety of energy and wanted nothing to do with technology. Then oil fell back below 100 within months. Fear cooled, and QQ rallied about 54% from the bottom. That was an 87% swing from trough to subsequent peak. The crowd fled the future at the exact moment the future got cheaper. That is why I care far more about the recession question than the oil question alone. If the answer is no recession, then a lot of the selling and quality growth names is merely fear wearing a macro costume. If the answer is yes recession, then I get more patient, more selective, and more defensive. That is the gate fifth mechanism. I call it the false refuge. During every panic, people want a bunker. They want an asset whose price action will calm their nerves. The problem is that the crowded refuge is often exactly where risk hides once fear begins to fade. I understand why money runs into energy, gold, and defense in an oil panic. Those trades are emotionally coherent. They match the story, but matching the story and matching the return are not the same exercise. By the time the public feels safe buying the refuge, much of the easy money has already been made. The valuation can become detached from the long-run earning power. Meanwhile, the sectors being sold are often not being sold because their business model broke. They are being sold because people need emotional relief. That distinction is worth a fortune. When people dump technology because oil is up, I ask a simple question. Did the demand for semiconductors disappear? Did enterprise software stop mattering? Did broadband stop carrying value? Did data centers suddenly become obsolete? Did great management teams forget how to allocate capital, or are investors simply choosing narrative comfort over arithmetic? If the business is intact and the price is lower only because fear is broad and indiscriminate, then I am being offered a better expected return, not a worse one. That is how I think in moments like this. I do not ask what feels safe. I ask what became cheaper without becoming weaker. Sixth mechanism, I call it the fear discount. This is where the opportunity really starts to matter. I have never made my best returns by chasing what was obviously working in the moment. I made them by buying businesses whose long-term economics were still sound while short-term panic created a sale. Right now, that is the area I would be studying the hardest. Several large real businesses tied to AI infrastructure, semiconductors, computing, and enterprise demand are trading at valuations that look far more attractive than the headlines would suggest. Look at simple measures like the PEG ratio, price to earnings relative to growth. A PEG under 1 often tells you that the market is pricing the company more cheaply than its growth rate would normally justify. When you start seeing names such as AMD and Qualcomm around 0.57, Dell around 0.61, Micron around 0.64, and Broadcom around 0.75, you should not conclude that the future disappeared. You should conclude that fear may be forcing a clearance sale in businesses with real revenue, real cash flow, and real demand behind them. This is not the year 2000. These are not fantasy tickers with no product and no profit. These are businesses sitting in the stream of modern computing demand. AI did not stop needing chips because oil jumped. Cloud demand did not evaporate because tankers slowed. Digital infrastructure does not stop compounding because television discovered a new scary chart. That is what makes these moments so awkward for the average investor. The thing that looks safest is often priced richest. The thing that feels most uncomfortable is often priced best. Seventh mechanism, I call it the capital spring. Markets do not only move because news changes, they move because positioning changes. There is about $7.8 trillion parked in money market funds right now. That is an extraordinary pool of parked caution. That money is not gone. It is waiting. It is sitting on the sidelines collecting yield and pretending patience is a permanent identity. It is not. Most idle capital has a hidden itch. It wants clarity. It wants a narrative that allows it to move without embarrassment. When clarity improves, that money does not usually chase what already had its panic rally. It tends to flow back into quality assets that became discounted while everyone was hiding. That is why time matters so much in a crisis. The best returns are often made in the narrow period between peak fear and obvious relief. Once the all clear is visible to everyone, the bargain is usually less attractive. I want to be very clear here. I am not telling you that every tech name is automatically cheap. I am not telling you that oil cannot go higher. I am not telling you to ignore the possibility of a prolonged disruption. I am telling you that the market's first instinct in an oil panic is often too emotional, too linear, and too anchored to the present tense. That is precisely when disciplined investors get paid for thinking one layer deeper. Now, let me tell you what I believe most people miss about crisis investing. They think the big money comes from prediction. It usually does not. It comes from protocol. If I had to reduce this whole situation to an operating system, it would sound like this. First rule, separate the spike from the regime. Do not treat a violent move as a permanent state until duration proves it. Watch the clock, watch whether supply routes reopen, watch whether prices normalize or stay elevated long enough to damage spending behavior. The market will try to force you into certainty long before the evidence deserves it. Second rule, watch the recession gate, not just the commodity chart. High oil by itself is painful. High oil that lasts long enough to reduce spending, hurt employment, compress profits, and freeze credit is far more dangerous. If recession odds are rising because duration is worsening, your posture should change. If recession odds are not crossing that threshold, then panic selling in quality businesses can become your entry point. Third rule, never chase what the crowd is using for emotional anesthesia. Energy can work for a while, gold can work for a while, defense can work for a while, but a trade that has already become everyone's espiological blanket is not where I expect the best multi-year return to begin. The obvious refuge is often where upside has already been spent. Fourth rule, buy quality where fear is nonspecific. I love broad fear because it is lazy. It sells strong and weak things together. That is wonderful for anybody willing to sort. If semiconductors, enterprise infrastructure, AI enablers, and efficient compounders are marked down because investors suddenly decided oil invalidates the future, I pay close attention. Fifth rule, scale, do not lunge. This is where ordinary investors sabotage themselves. They either freeze or they bet like cowboys. I prefer neither. If I believe quality assets are on sale, I buy in pieces. I keep liquidity. I let volatility serve me. If prices fall further, I buy better. If prices recover, I still participated. Scaling turns uncertainty into an ally instead of an enemy. Sixth rule, keep leverage on a leash. An oil shock is not the moment to discover you built your life on perfect conditions. Debt is a wonderful servant when times are stable and a vicious master when volatility rises. If you want to invest through fear, you need the staying power to remain rational while the screen is red. Excess leverage destroys that privileged seventh rule. Let arithmetic outrank mood. The market is a voting machine in the short run and a weighing machine in the long run. During oil panics, the vote gets emotional. My job is to care more about the weight. What will these businesses earn over 5 years? What will the capital return look like over 10? What is the price I am paying for that stream today? That arithmetic is what eventually wins, even if the mood has to exhaust itself first. Now, I want to say something blunt because this is where investors usually tell themselves a pleasant lie. They say they are long-term investors, but what they really mean is that they are long-term investors when conditions are quiet. The moment gas rises, the moment the market drops, the moment scary maps show up on television, they become short-term emotional reactors disguised as prudent people. A real long-term investor is tested precisely here. Can you distinguish a genuine impairment from a public panic? Can you admit uncertainty without surrendering discipline? Can you buy what is uncomfortable but logically advantaged? Can you stop treating headlines like orders? That is the test. There is another reason I like these moments, and it has nothing to do with enjoying fear. I do not enjoy fear. I enjoy clarity. Crisis strips investors down to their real operating system. It shows you whether you built a philosophy or merely borrowed one from a bull market. When everything is rising, people talk beautifully about buying quality businesses, letting compounding work, and thinking in decades. Then the world gets noisy and they go shopping for protection at any price. That is not an investment philosophy. That is emotional improvisation. If I were managing this exact environment for a young investor, I would tell them something simple. Do not make your biggest decision based on the first week of the loudest chart. If I were speaking to an older investor who needs more cash flow and less volatility, I would tell them something equally important. Do not abandon your discipline to chase what just had the panic rally. You may need more defense, but defense bought at peak excitement is often just another form of speculation. And if I were speaking to the middle-class family trying to protect a lifetime of work, I would tell them the hardest truth of all. The market punishes people who confuse stress relief with wealth building. Stress relief says buy what feels safe today. Wealth building says buy what is logically cheap relative to future cash flows and hold it through discomfort. Those are rarely the same thing. Let me put the whole situation in plain English. If this disruption resolves in weeks, the crowd that chased oil will look backward and realize they paid a premium for fear while selling the future at a discount. If it drags for months and crosses the recession gate, then caution becomes more appropriate. But even then, the best opportunities will still come from discipline, selectivity, and staged buying, not from theatrical panic. Either way, your advantage does not come from shouting louder than the market. It comes from seeing that the first move and the right move are often not identical. I have no interest in pretending certainty where it does not exist. I cannot promise the strait reopens on your preferred timeline. I cannot promise oil drops next week. I cannot promise that every discounted technology company becomes a great investment. What I can tell you is this: 5 major oil spikes over 50 years produce 5 reversals. Every time the crowd wanted the same trade. Every time the crowd treated the immediate winner as if it were also the long-term bargain. Every time patient capital that bought quality after indiscriminate selling had a chance to be rewarded. That pattern matters. And I will tell you one more thing, because this is where real money gets made. When fear peaks, the decision is never obvious. If it were obvious, the return would not be there. The reward exists because the moment feels unsafe. That is the price of admission. So here is the contract I would make with myself in an oil panic. I will not chase what already ran because it matches the fear in the air. I will not sell future earning power just because present emotion is loud. I will track duration, recession risk, and valuation. I will keep cash, buy in stages, and insist on quality. I will remember that the market's favorite hiding place in a crisis is often the place with the weakest next return. And I will accept that the window between peak fear and obvious recovery is short, uncomfortable, and immensely valuable. That is where the crowd usually blinks. That is where disciplined investors usually begin. And 10 years from now, when people pretend this period was easy to navigate, I want you to remember what really happened. The television said buy the spike, arithmetic said buy the discount. One of those voices will help you feel better for a week. The other one can change your financial life.